class, I'm going to mix up the term security. And sometimes I'll say security, sometimes I'll say asset, sometimes I'll just say Bitcoin or cryptocurrency, or I'll say the euro, or I'll say Apple. Okay. It doesn't matter. All I'm trying to do is give you some variety. Okay, because tonight, the concepts we're talking about apply to any publicly traded financial instrument in the open marketplace. Also, I'll intermix the terms investing and trading. Now, typically, an investor takes a long-term position, while a trader takes a much shorter-term position. Most of us here tonight are going to be traders. In either case, the basic concepts and techniques presented in this class are equally adept. It just gets very, very boring saying trading, 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 or investing, investing, or saying security, security, security. So I'm just telling you that because over the years I've gotten lots of emails. Well, you said that would work with the euro, but will it work with Apple stock? What we're talking about tonight will work with Apple as well as it'll work with the euro. Now, all of us are sitting out there and you're all asking one big question. Should I buy today? Or you could be asking, should I sell today? But you all want to know what the prices will be later today, later tomorrow, next week, or next year. Now, wouldn't investing be easy if we knew the answers to these seemingly simple questions? But let's face it, I don't have a crystal board. I don't have a Ouija board. So nobody has the answer to these questions. So if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you earlier. It doesn't. However, if you're attending tonight's webinar with hopes that technical analysis will improve your investing or trading, I have good news for you. It sure will. Because ultimately, investing and trading is about risk analysis, risk management, and money management. So let's get started talking about technical analysis. Now, too many of us think that technical analysis is a complex science that is all involved in these mathematical equations that we call indicators or oscillators, like MACD and stochastics, and ROC and CCI, and all of these, and they're all involved in these huge algorithmic law mathematics and everything else. Well, that's farther from the truth as you could imagine, because technical indicators is only one small little end of the end segment of technical analysis. Technical analysis starts out with charts. We could call it chart analysis. It's anything and everything we do on a chart. Just looking at a chart is technical analysis. From there, we use technical analysis to identify patterns that we see in price. Because historically, we've learned that when a specific pattern appears in a price movement and that pattern's appeared in the past, we can interpret that. Okay? And it will help us predict where prices came from, where they are now, and where they're going. So all of this makes up technical analysis. Some of us just use adding a trend line on a chart or support and resistance levels is technical analysis. Okay? You don't have to get in all of those involved oscillators and indicators. So anything done using a financial chart is technical analysis. So there are three different types of analysis: indicators and oscillators, trend analysis, and chart patterns. But remember, we could just call all of this chart analysis, and I wish we had a long time ago, because that's a lot less scary than technical analysis. So technical analysis is the forecasting of future financial price movements based on the examination of past price movements. But like weather forecasting, technical analysis does not result in absolute predictions about the future. Even today, with all of our technology, the weather report changes continuously. Today, where I am, we had rain. But the rain was supposed to come in this evening and last till tomorrow. It changed hour by hour today. And to be honest with you, it said rain all afternoon. And I was out wearing just a shirt and a hoodie and perfectly fine. And there was no rain. You tell me, why couldn't the weatherman get it right? Well, you need to watch it for its continually updating. Okay. Same thing with technical analysis. It'll tell you what's happening now, what to expect shortly based on the patterns. But if you don't keep an eye on it, it's going to trade, because price action is ultimately what controls everything. So just like with the weatherman, he's predicting using all types of tools, but it's really what's going on outside my window that's telling me something. With technical analysis, it's ultimately the price that's appearing on that chart. It's looking out your window and seeing that rain. So the relationship you have between you and price on a chart is what's crucially important. Now, technical analysis is based on 3 assumptions. So already we're calling it technical analysis, it's high-end technical. It's referred to as a science, but it's based on assumptions. Now, before you get all confused and before you have to try to spend all this time really paying close attention, I've given you a handout. It's an excellent, excellent booklet on technical analysis. It covers A to Z. You can download it right now by clicking the button, download it right to your whatever device you're using, because it's only available during this live class. But it's going to explain over and over again everything I'm explaining to you tonight, because I'm not going to give you any hidden secrets. I'm just going to try to explain it to you so that you understand it. And so does the booklet. But technical analysis actually came, it's the newest part of actually trading. It came in the 1900s from a very famous person that we all know. You may not realize you know him, but his name is Charles Dow. And why do I say you know him? Because you've heard of Dow theory, but what have you really heard of? The Dow Jones. Okay. Up until Dow introduced his idea of using price and price patterns in technical analysis, everybody traded based on fundamental analysis. You know, news, headlines, crop reports, economic events. And Dow proposed 3 main theorems here. Number 1, history tends to repeat itself. Now, I qualify this, okay, because technical analysis is based on looking back at price action over the past to find levels that were important to that asset when it was trading in that field. So in other words, if oil is trading at $53, we can go back to when it was trading maybe 4 years ago, the last time it was at this level, and see what happened around $53. What were the traders doing? What price points over the years has been a difficult time to get through? Okay. And the more times that when you draw this line through, that you see the price, we're not saying it doesn't go through, but we see that as price is moving up, 53.01, 53.02, it tends to hesitate at 53.06. Did that 6 years ago? It did it 1 year ago. It did it last week. It did it 2 days ago. And the more times it's done it at that price, the more important that price is. Because all it's trying to do is give you some information. So the history is trying to tell you that it will tend to repeat itself. Now, I qualify this because when Dow came up with it, the markets traded very slowly, and we didn't have online trading. And we had only professional traders or brokers taking trades. Today, the world has changed because online trading has grown to be so huge, and it's made up of so many people. You know, if we go back to even the 1980s, the actual amount of people actually trading, the volume of trades going through the market were very, very small. And the fact is, it was being done by professional traders, all who came from the same schools, not the same physical schools, but they came from the same school of thought. They came from the same overall trading. They all kind of talked to each other. And so history did tend to repeat itself. But as we moved to the 1990s and the 2000s, and online trading became so popular and brought so many people into the marketplace that, and we got this fast computerized trading, that the people and the psychology of the markets changed. So I say, don't go back and look at historical prices more than a couple years ago, because this price point might have been important 10 years ago, But the market was it was made up of different people who were reacting. You need to see. So I say don't go back any farther than that. Now, sometimes with an asset, like when the euro fell down to 106 or 105 last year, it hadn't been at that point in 10 or 15 years. And you had to go back that far to see when it had actually traded at that level. Okay. So sometimes you're forced to go back. Now, the second part is price moves and trends. Now, the market can only move one of three ways. It can only move up, down, or sideways. Now, what would surprise most traders who don't even realize it, but markets tend to trade sideways most of the time. So to find a market that is actually trending up or trending down is very unusual. Yes, you can find an asset that's trending up in a very short period of time because it's moved up, over the last 2 hours. But overall trends tend to be sideways because the markets don't move that much. When you talk about the euro jumping, it went from 113.42 to 113.48. Well, that's a big move for the euro. Yeah, let's leave cryptocurrency out of this scenario. Although, if you want to trade crypto, the only way you can analyze crypto is with technical analysis, because you can analyze a stock with earnings reports and its quarterly releases. You can analyze the euro based on the central bank and economics data. When it comes to cryptocurrency, you have nothing that's affecting it because the news isn't big enough to necessarily drive the price. And because it's not about an economy or a centralized government, a little bit of news out of Korea isn't going to have an effect on Bitcoin in the US. So what are you trading it with? You're trading it with technical analysis. But the rule of thumb in technical analysis is that markets move three ways. And they don't move a great deal. And if you look historically, when price jumps up, it eventually comes back down to that same level. So uptrends, regardless of how hard that uptrend was, eventually comes back to a downtrend and it stays at that level because this is the water level. So if you look at a lake or a sea, it might go up during rainy season, come down during the summer season, but it stays at the same average level. But this is where we get the trend is your friend. And we always say we only trade with the trend. And last thing, the markets discount everything. No matter how fast you think you can get the news, no matter how fast you think you're going to get the economics data on the calendar, which you get very, very quickly, there's so many people that were in the market ahead of time that drove the price up or down that the markets have already taken that into account. So only when you get some weird stuff like if the central bank doesn't increase interest rates when everybody thought it was, you'll get a weird blip in a second. But technically, when all the pros know what the central bank's going to do, you can actually see that they've taken position ahead of time. They're already in the market. So the market's already discounted everything. So these are the three bases for technical analysis. So I say this big scientific field is based on a whole bunch of bunk because none of this is really too scientific. But ultimately, price movement is not totally random. Most technicians agree that price trends. However, most technicians also acknowledge that there are periods when prices do not trend. If prices are always random, it would be extremely difficult to make money using technical analysis. Now, we have the two fields of study, technical analysis and fundamental analysis. Okay. Yes, if you're a black box trader, is all based on technical analysis. Okay. Newbie traders all tend to be trading on fundamental analysis. It's really easy to understand that the central bank is raising interest rates, so gold should go down, dollar should go up. If inflation numbers come in high or Trump does something crazy, we can predict what the markets are going to do, and that's called fundamental analysis. But to be honest with you, most traders and most successful traders use a combination of technical analysis and fundamental analysis. There's nobody who's a hardcore technician outside of really high-end professionals. Now, me, I'm a combination technical and fundamental analysis. I believe in them both. Now, I use real basic technical analysis because I use trend lines, I use support and resistance, and I use volume. I don't actually use any indicators in my trading. I'm a price action trader. I believe in price pattern. I like to find triangles. I like to find wedges. I like to find flags and pennants. I don't really care what an indicator's telling me because I don't, they're all open to interpretation. But that's me. And then I always watch the news. But one way of viewing is that the markets may witness extended periods of random fluctuation interspersed with shorter periods of non-random behavior. The goal for chartists is to find these periods. This is what we're looking for as a technician or a chart analyst, is when we can find a clear period that we have non-random behavior. In other words, when we can find an asset that is definitely trending up or definitely trending down, then we're in a period of non-random behavior. And those are the only assets we really want to be trading. So if we can isolate just those assets that are exhibiting non-random behavior, we can then find lots of trading opportunities. And that's the field of technical analysis. Now, technical analysis can be as complex or as simple as you want it. Okay. Now, over here, you see a pretty simple version. I got volume on the bottom of my charts. I've got a trend line. I've got support and resistance. I'm looking for the price to come out of congestion and move into either an uptrend or a downtrend. But for us as chartists, we have to understand and how to learn to read charts. Now, there's no way in this class we're going to really discuss charts because we have an entire 1-hour class dedicated to charts. So I would have to take this entire class just to understand and explain to you about charts and how to use time frames and how charts work. But basically, we have 3 types of charts. We have bar charts, line charts, and candlestick charts. As newbie traders, the buzzword today is candlestick charts. Now, I'm a long 45 years of trading, and I use bar charts. Okay. Now, today, because we have these wonderful computerized charts, we can just select whatever we want to select. But financial charts are essential tools to traders who wish to use technical analysis to determine where to invest their funds. Technical analysis is the review of past market prices and technical indicators to predict the future short-term movements of an investment. Okay. Now, again, no matter how you want to trade, if I said to you that Apple just released their sales figures and they beat estimates, the sale of iPhones has gone through the roof, and they're introducing 2 new products, well, you know their price is going to soar. Okay, right? That's a pretty basic fundamental decision. Okay. But how are you going to know where it was, where it should soar to? How do you know if it's too late for you to get in the market because basically all the big traders had already jumped in the market and pushed it price too high? How do you know when it's hit the top of its price and ready to start coming back down? Well, first of all, you can only do this on a chart. Because if I said to you, the euro is trading at 113.42 right now, and it was at 113.44 a little while ago, and it's up to 113.47 right now, and it's going to go back down to 113.42, you can't even remember what numbers I just told you. But if I were to show it to you on a chart, your brain can then understand it because it can visualize the price. So that's one of the basic reasons you need to use charts, because you can see price, because you can't remember all of these numbers. So if I were to say to you, Apple's trading at 137.52 right now, and Apple should go to 137.65, but it just dropped down to 132.47, can you make any heads or tails of that? But if I showed it to you on a chart, or on one of these little bars or one of the candlesticks, you'd understand exactly what I just said and exactly what prices it was at. So a chart can only give us a certain piece of information, but it gives it to them in a very vital format. In fact, all technical indicators can only base on price movement and volume, and they all base everything on open, high, low, and close for that period. And they give it to you in just different visual formats. Okay, same numbers, whether you're using bar charts or candlesticks, doesn't change what the open, the high, the low, and the close were. It doesn't change the volume. Can't change it. They are indelibly etched into the permanent reality of that asset. It just can show it to you in a different visual format. But once we've got price on our charts, we then want to start interpreting that price. And we can interpret that price by looking for repeated patterns that we see on a chart. You've read about them sometimes. You hear about candlestick, you hear about teacup pattern. You'll hear about head and shoulders. But one of the most popular, and my favorites, is triangles. Now, granted, we have ascending triangles, descending triangles, symmetrical triangles. That just depends on how they form in the trend line. But once you see a triangle forming, what does that tell you? It's not so complicated. That price is being pushed into an apex, being pushed into the center of this triangle. Traders were getting tighter and tighter and tighter in here because this is what price is actually doing. At some point, price has to break out of this triangle. Triangle doesn't tell us which way price is going to break out. It's telling us that the traders are getting pent up, and sooner or later they're going to break out. Now, they can break out upward or they can break out down. But there are certain formulas that we can apply based on the width of the triangle to the momentum. But when we see a breakout of the triangle, okay, we can look at volume, and a volume supporting that breakout, because volume should surge when it breaks out. We then can trade that asset going in the direction of that breakout. Okay. That's a very easy way to interpret price on the chart. So we have things like falling wedges, bullish rectangles, bullish pennants, rising wedges, bearish rectangles, bearish pennants. And we can use all of this to determine where to put our stop loss, our entry point, and set our targets. Well, that's not very complicated. It's simply looking at your charts and be able to see these price movements in charts. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between the buyers and sellers of financial instruments in liquid markets. Pattern formations do not make a trading system, but rather provide an indication of the future trend of shares of a price at key psychological barriers. So I'm going to share with you a little presentation we've done on this. And again, the field of technical analysis is very, very large, and most people don't realize how much is incorporated in there and they want to get scared of it. So I'm going to share with you this little presentation on trading triangles and pennants and flags, and you'll see how easy it is. So chart patterns are not very complicated. They're based on lines that we can place on our price action, but you can actually visualize a triangle. But these are using what's called support and resistance lines. Okay, support and resistance levels are also price levels, like I mentioned in the historic prices. These are prices where price in the past has had a hard time breaking through, eventually broke through. But if you just imagine support and resistance is like an elevator. The floor below your feet is supporting you. The ceiling above your head is your resistance. When you break through that ceiling, it becomes the support under the new floor under your feet, and the next ceiling becomes. Now, if we were to analyze this elevator over a long period of time and the building where the elevator was, we could see times a day and price levels that that elevator tends to stop at. Like maybe it's a 50-story building and on the 49th floor is a restaurant. Well, that restaurant's only open for dinner time. So during the day, you know that elevator's not going to stop there, but also there's people working on all those floors. During the day, it's going to stop at the random floors, but maybe there's a conference center, maybe there's a smoking center, and you can see based on time of day. Late at night after the restaurant's closed, okay, you can actually probably watch the elevators moving up and down as the janitors and cleaning crew go up and down. And these form what are some known as support and resistance lines. So you can start analyzing price movement on your charts using these levels. So as a trader, you probably heard the old adage that it's best to trade with a trend. The trend is another line that we can draw on our charts. This is using price points to establish that we have a trend, okay? And a trend is a direction of prices moving. We mentioned there's uptrends, downtrends, and sideways trends. And then a trend line is a defined line that we can put on our charts that tells us that we actually, when we draw it, we can see that we actually have a good trend. And that's when the trend will say the trend is your friend. Now, this is sage advice as long as you know and can accept the trend can end. But this is support and resistance chart patterns, trend lines, and volume become the ultimate parts of all of your analysis. And they also can make up trading systems for you. But no matter how you're trading, these are the parts of technical analysis that you need to incorporate in any trading decision. And I don't think I told you anything tonight that was so far tonight that's been that scary. Okay. Because you should always trade with the trend. We have uptrends and downtrends. And when we can find these well-defined uptrends and downtrends, which are defined by higher highs and higher lows. So in other words, in an uptrend, price is pushing up. It's making a higher high. Then it's easing back down to make a higher low, pushing back up to make a higher high, then easing back down and pushing back up. Now, when we can understand these trends, because what happens is price doesn't move this way. Price moves in peaks and valleys because the traders start to buy. The buyers become confident and they start entering the market. They're pushing the price up. Some point, the guy who entered down here says, oh, you know what? I reached my profit target. I'm going to sell because I want to book my profit. Okay. Because he's only looking for 10 points on his trade. He already set his target point before when he entered his trade. Okay. So he starts selling. He sells out here. Other buyers who are sitting on the sidelines say, you know, this price is getting a wee bit too high for me. I'm going to wait for it to ease back down before I enter. So they move to the sidelines. This guy moved out of here. And what happens is price eases down. As it eases down, the sellers that were selling off a profit have cleared out. And these buyers who moved to the sideline, that price has gotten lower again. I'm going to jump back in the market and start buying. And they push it up to form the next high. Okay, again, this happens. Okay, and these form the peaks and the valleys, or the cycles or the waves of a trend. Okay, and there's all kinds of ways to interpret these, but when we can see a well-defined trend, we can then safely trade in that market because when a trend starts, it will keep the momentum. Although you have to remember that each trend, whether it's uptrend or downtrend, is a lot of work. Even when price is falling, it sounds like, you know, a ball falling down is easy. It's just running against gravity. But still, it takes a lot of effort by the traders to force price down or force price up. And so they're going to work and push it up. but then they're going to get a little bit tired and going to let it ease back down. Here they're pushing hard to push it down, and they're going to ease back a little bit and rest and come back. So remember, it's a constant tug of war. Just want to get my markings off here. So before we get started, I want to mention the importance of time frames in determining trends, because you can have short-term uptrends, medium-term downtrends, and longer-term uptrends. Okay. So when somebody says that a price is trending up, you have to find out what period they're talking about, because like the euro is in an uptrend right now because it's been steadily recovering from 112 to 113 to 114 to 115. But it's way off the 132 it was at, but it's off that 105 where they hit the bottom. So it's in a longer term downtrend, and it's just simply recovering some of its loss. And it's in a short term uptrend. Okay. By comparing these and understanding the differences in time segments, you can then incorporate this into your trading strategy. Like I will enter a trade based on the trend in the last 15, the last 1 hour short period, but I'll only make my decision based on a 4-hour chart. I'll make my decision I want to trade this asset to go up because I see it trending up in a longer term chart. But my entry point will come from my shorter term chart. Because the goal here is to determine the trend direction, not whether to enter or exit a trade. Of course, this is not to say that there were no trading opportunities in shorter time frames, such as daily or hourly charts. But for those traders who want to trade with the trend rather than trading the correction, one could wait for the trend to resume again and trade in the direction of the longer term trend. So a trending market is one in which price is generally moving in one direction, making higher highs and higher lows. Now, other than eyeballing price action, you can make use of all kinds of technical tools. So we talked about trends and trend lines, support and resistance levels. Okay. Then we have moving averages. Moving averages are also a way to clear the noise out of the marketplace. See what price is trying to tell us. Because the market ebbs and flows. They go up, they come down, they move sideways. The primary ways to make sense of these are analyzing price action, well as levels at bounce higher and rotate lower. We call those levels support and resistance. Support and resistance can be gotten from looking at those historic levels or using moving averages to determine these levels. So moving average are what we consider dynamic support and resistance levels. Okay. And what I mean by dynamic is moving levels. See, historic levels stay flat. Okay. We have moving levels or moving averages. A moving average moves up and down according to what price is doing. And you can set it to consider a certain number of bars or time periods. So my personal favorite is using a 7-period or a 50-period moving average. And I like to use them on the daily chart frames. We can watch for price to test the moving average. And when price stays above the moving average, we have a market that's moving up. When it's below the moving average, we have a market that's moving down. So here, let me try to show you some basics of moving averages, because all this is the field of technical analysis. And you notice we haven't talked about any indicators yet. We haven't talked about this complex mathematical So moving averages fall again into the field of technical analysis because, again, anything we do on a price chart is part of technical analysis. Now, another popular tool in technical analysis is called retracement levels. Now, we have several different types. One of the most well-known is Fibonacci retracements, which I don't use, but doesn't mean they're good or bad. I mean, it's not my personal view that they're bad. None of us can use every tool out there. I use the minimal amount of tools. But Fibonacci retracements are very popular. It's a tool that goes on your chart and will calculate several of the retracement levels. The belief is when a price moves up, it will then ease back down, like you saw when we were talking about the trend line, pushing up, easing down, pushing up, easing down. Well, a Fibonacci tool will help you figure out where each one of those eases should be at. And as price eases down, it will either hit the 38.2 level, the 50% level, or the 61.8 level of the prior move. And this is another tool we can use as part of technical analysis. Now, from the Dow theory, the 50% retracement level has become very popular in all markets and holds very true. And that's the belief that if you measure the prior movement, it's very much like Fibonacci. But if you measure the prior move, so we here have a beginning of a move up here, and we have the end of the previous move. This is the end of the previous trend. That as the trend reverses, it will tend to retrace 50% of the previous move. And we see it came down to that 50% level, bounced off, came back up, moved back down to that 50% level, and then moved back up off of that level. And this is just one way to do analysis of the market to try to understand where it's moving and how to split your stop losses and your take profits. And then last, we come to this big, scary field of technical indicators. A technical indicator is a mathematical calculation that can be applied to an asset's past patterns like price, volume, or any other technical analysis. Some technical analysis are indicators technical indicators using a different indicator. Like we have RSI stochastics. That's RSI and stochastics combined together. We have MACD, which uses moving averages and then adds more on to those moving averages to become the moving average convergence and divergence. Okay. But all of them are based on 4 basic pieces of information. Well, it's 2, price and volume. Price is the open, the high, the low, and the close. And volume is the amount of contracts, shares, or how many buys and sells are for that particular asset at that time. Technical indicators do not analyze any part of the fundamental business. Technical indicators could care less about what Donald Trump's doing, what the ECB is doing, and what inflation rates are doing. Could care less about elections anywhere. Could care less about military action. Technical indicators are strictly mathematical calculations. They don't care about earnings reports or profit and loss. Now, technical indicators are most extensively used by active traders in the market, and they are primarily designed for analyzing short-term price movements. To a long-term investor, most technical indicators are of very little value. Because if you're a long-term investor, you're looking at buying something at a lower price for the price to move up over term to a higher. Okay? Where an indicator is telling you right now what it's doing. Okay? If you want to buy gold or Bitcoin, okay, it might help you when to enter the market precisely. But if you're looking for a long-term trade and you're looking to buy Apple today at 135 and hoping when you retire it's at 160 or over 200, do you really care if you bought it at 165.10 or 165.35? Because you're looking for the long-term effect. You don't even care if it jumps up and down. Most long-term investors aren't buying and selling gold. Most of the wealthiest families in the world, they bought their gold hundreds of years ago. They never sell it. They're just looking for it to steadily increase 10% per year. And they don't even care per year. They're just looking for a steady increase of 10% to increase their wealth and their value. But indicators they'll alert traders about a trend. They'll predict the direction of future prices, and they'll confirm with other indicators what the market is doing. Now, there are three reasons to use technical indicators: smoothing out market fluctuations, define key price levels, and gauge an asset's momentum. Now, there are literally hundreds and hundreds and hundreds of different technical indicators. And thanks today to online trading and easier computer programming, computers around the world, every day there seems to be another one coming on the market. Now, the most well-known ones are the ones that were developed 30, 40, 50 years ago that have withstand the test of time. RSI, stochastics, MACD, ROC, CCI. Most of these are what we call overbought and oversold indicators. They'll let us know whether the momentum of an asset is about to slow down. They don't tell us that the asset is about to fall. Imagine a rocket moving up into the sky, okay? Or you shoot a firework up in the sky. You don't know exactly how high it's going to go, and you see it not moving as fast, so the momentum is slowing down, but you don't know exactly what point it's going to flip over. But as it's losing its momentum, you know it's going to flip. And we have indicators that fill what's called the lagging indicators and leading indicators. Leading indicators predict what the market's going to do. Lagging indicators tell you the market just did this. Now, they tell you very close. They're going to tell you the trend has now reversed itself, or the trend looks like it's going to reverse itself. So you decide what you want to use. Now, most indicators, actually, let me pop up a live chart here. Most indicators are just dropped on your chart today. You don't have to calculate them. You don't have to know what they're calculated from, but you should understand where they come from. But I have whole 1 hour classes in just using Bollinger Bands. Now, Bollinger Bands is one of the indicators that's actually dropped over price action, and it uses something called standard deviation. Then we have other ones like I keep mentioning MACD, moving average convergence and divergence. And you can see this list goes on and on and on here. Okay, but the most popular ones that one to still use, most indicators are dropped below the chart. Okay, and you have what we call bounded oscillators. We have oscillators. We have all different types of them. Okay, you can't master any one at one time. But once you figure out the ones you want to learn, we have whole 1 hour classes in each one of those. Okay. But these are all the field of technical analysis. Like I said, let's get the Bollinger Bands off of here. And now we mentioned moving averages. I already got some set up here, and I'm just going to put them on the charts. Okay. And these are simple moving averages and moving average crossovers. Okay. You can use any of this to make trading systems. You can make it as complex or easy and understand what price is trying to tell you. Here we have a nice channel going down. We see price hitting the bottom of the channel, bouncing off the channel. We have our trend line drawn on here. We have our channel, and we can see price peaking up, making troughs and down below. Okay. Now, there's many different ways that we can use technical analysis. You can make it easy. You can use it complex. You can use indicators. You can use chart patterns. You decide where you want to start out with a little bit. Start out with a trend line and support and resistance levels. Okay. And take it from there. And you can move it as far, and as complex, and I keep adding to it. But technical analysis is this whole field of everything and anything done on charts. So on that note, I'm going to say goodnight to everybody. I hope you learned a little bit about technical analysis. I hope you're not as scared of it anymore as we were when you first started. I hope you realize there's lots more to technical analysis than simply, I'm sorry, I'm just trying to get my PowerPoint back up here for you. Uh-oh, there we go. Then there's a lot more to this field of technical analysis than simply these oscillators and indicators. Things you don't have to be scared of. Support and resistance lines, trend lines, volume, all of this. Oh, that's what I didn't show you before. Let me just show you real quickly. Let's go back to the chart. So volume is added onto your chart. right below, and we can see how volume increases as price changes. So here we see a steady flow as prices moving down steadily in the trend line, and we can see volume confirming that. Here we see it hit the bottom, and then all of a sudden we bounces off the bottom, starts moving up. And look at that, as price starts moving up, the buyers jumped in the market. They pushed the price up to this level, but this is an old resistance level. And then the buyers jumped out of the market again. There was nobody in the market, no activity. So that's telling you that this move up wasn't supported. It was, a lot of people took profit, but it wasn't supported. But you can see how the combination of buyers and sellers in the marketplace, volume, and where price is moving. Do they support this move or do they not? And you'll see sometimes you have high volume. You see volume on this chart also here. And you can see periods of very, very high volume, and that coincides with price movement. So again, on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. And if you want to learn more about this, just go to www.ubcfx.com and sign up at their education center. You can get a demo account. There's no charge, no credit card required, and you can use their education center to start learning more about technical analysis. Have a good night now, and thank you again very much. Bye now.